Hey, traders! Today, I'm walking you through my latest options trade on Tesla, a bullish call debit spread that I just entered. I'll break down the trade details, the setup, and most importantly, why I chose this trade based on risk reward and probability of success. Plus, I'll show my trade confirmation and explain exactly why this spread costs $201 per contract, so you can understand the math behind debit spreads. Let's dive in. This is a call debit spread on TSLA, meaning I'm betting on an upward move while keeping my risk defined. Here's the exact setup I took. Bought the 365 call for $4.25. Sold the 375 call for $2.24. Expiration this weekend, February 14th, 2025 weekly options. Total cost $2.01 per contract, $201 per spread. Max profit potential $7.99 per contract, $799 per spread. Break-even price $367.01. How is the $201 cost calculated? Since I bought the 365 call for $4.25 and sold the 375 call for $2.24, the total cost is 4.25 minus 2.24 equals 2.01 per contract. Since each option contract represents 100 shares, we multiply by 100. $2.01 times 100 equals $201 total cost per spread. This means my max risk is capped at $201 per spread, and I don't need to worry about unlimited downside. So, why did I pick this trade? There are two key reasons: technical analysis and risk management. $350 is a critical support level. Tesla tested $350 once, but this level is even more important because it was a strong resistance on the way up before it flipped into support. That's a classic technical pattern. Old resistance becomes new support. As long as Tesla holds above $350, I like the odds of it pushing higher toward my target zone. I am betting that Tesla will stay above my break-even price of $367.01 by the end of the week, which means I don't even need a massive rally, just some continuation above key levels. Now, here's why I structured this trade with a 1-to-4 risk-reward ratio, and why you should always think in terms of risk versus reward, not just probability of success. Let's break it down. If I lose, I only lose $201. If I win, I make 4 times what I risk, $799. This means I only need to be right about 30% of the time to be profitable. Think about that. I can lose 7 out of 10 of these trades and still be profitable over time. Most traders focus on being right, but I focus on making profitable trades, even if I lose more often than I win. That's why I structured this trade this way. Now, let's talk about how I'll manage this trade. I will not be cutting this trade early. It's an all-or-nothing play, meaning if TSLA is below $365 by expiration, I lose $201, the premium I paid. If TSLA is above $375 by expiration, I collect max profit of $799. If TSLA is between 367.01 and $375, I make a partial profit. This is how a call debit spread works. You define your risk up front, and there's no risk of blowing up your account. You either lose the premium paid or cash in on the spread's full potential. Now, here's where things get interesting. I may close the trade before expiration if it moves in my favor quickly. For example, if TSLA rips above 370 plus in the next day or two, I could lock in a solid profit and avoid any last-minute volatility. That's the power of options. You don't have to wait for expiration to take profits. If the market gives me what I want early, I take it and move on. So, that's my Tesla call debit spread. A high reward, defined risk play targeting a move above $367 by the end of the week. Let me know in the comments. Are you bullish or bearish on Tesla right now? And if you found this breakdown useful, drop a like, subscribe, and hit the bell so you don't miss my next trade. Happy trading, and I'll see you in the next one.